Welcome everybody. My name is Lawrence Gosling. I'm the editor-in-chief of What's Investment magazine, and I'm pleased to be joined again by the award-winning financial advisor, independent financial advisor, Stephen Jones from Clear Solutions, who is in fact a columnist on the magazine. So if you haven't seen his column, go and check it out. It's really, really useful and informative. And Stephen's very kindly agreed to kind of answer some of the questions that you pose into us that really, as financial journalists, we're not actually experienced enough or even allowed, because we're not regulated, to sort of give you any kind of answers or even anything resembling advice. Stephen, good to see you again. Thank you for joining me. First question up from a reader. I'm very interested in investing in high growth companies. Are things like enterprise investment schemes and seed enterprise investment schemes sort of suitable?
All depends on your definition of a high growth company, because at the moment, the high growth company everyone's been talking about is Tesla, which is quite definitely not the sort of category of the company that we tend to talk about. So generally, the description that we would use is the widely accepted one of any company that anticipates giving return above sort of 15% in the course of a 12-month period. We define that as high growth. But in the UK, when we use this terminology, we almost are even more specific than that when we're in the financial advisory profession. We mean younger companies that have that potential to do that and give you a real return on your money with significant tax advantages. And that's where, of course, your reader's question about enterprise investment schemes kicks in. Now, of course, I have a particular interest in this because I sit on the main board of the Enterprise Investment Schemes Association, and the tax advantage solutions is an area that I've been intimately and involved with now for many, many years. But so for me, enterprise investment schemes are an amazing solution for some clients. So if you have that interest in potential of a lot of return, you're willing to take risks with your capital, as I said, in terms of a higher risk compared to your standard stocks and shares style investments, then yes, that's an area that you would wish to be involved in. So your reader was asking, are they an opportunity? Definitely. Do they come with risks? Absolutely. Do they have an exciting time? Can you tailor them? Can they be diversified to get a very broad and wide portfolio? Can you be very, very specific in particular sectors or particular business interests? Absolutely. There's the opportunity to tailor as much as you wish and create a bespoke portfolio should you desire, or to have a much broader off-the-shelf solution.
And the follow-on from that particular reader was sort of, how can they decide between EIS and CDIS? I think there's clearly investment and tax differences between the two structures.
Well, I'm not going to go so much into the pure tax differences because you can easily Google those. They're very straightforward. What I think does matter is that you understand the risk return for it, because you can get very excited about the greatest tax advantages of seed, and they're unquestionably there. What perhaps is also useful to bear in mind is try Googling how many of investments in that space pay off. There's a very, very high failure rate at the seed level, which significantly reduces when you drop down to the enterprise investment scheme level. And again, to be fair, that drops down when you go down to the venture capital trusts, which are the next stage, etc. That's why we talk about higher risks. But the point about seeds, seed investment specifically, is that you're in very, very early. You have the greatest opportunity for a very high return. And if you're willing to risk that capital, go for it.
And you touched on venture capital trusts there, VCT. So sort of how do they differ from sort of EIS? Again, as you quite rightly say, anybody can sort of Google the investment differences and the tax breaks differences. But how would you sort of frame, I guess, what you would call the investment or the risk differences between VCTs and EIS?
Firstly, I think you probably need to understand where they fit in the development of a business, and the different stages of a business requires access to different levels of capital. We already clearly understand that the very earliest stage is business angel, followed by that seed investment, followed by the enterprise investment scheme. And when they get to a certain stage, then they get much greater sums of capital, and that tends to come in from venture capitalists. And in the UK, we have a very heavy and very expansive investment solution, which are the investment capital trusts. Now, they are, first of all, they're much more easily researched. They tend to have much bigger portfolios. So typically, an EIS can go from one individual specific company up to a portfolio of between 4 to 8, which still isn't a huge portfolio. Very occasionally, it might go up to 10. The venture capital trusts rarely are below 20, if ever, and can easily go up to 70. So the whole breadth of investments that they have within it are much, much broader, much wider. The companies themselves are at a later stage. They're all going to be revenue generating. Normally, if not exclusively, they're going to be in profit. And so you get, please bear in mind that some much, much bigger companies, the so-called unicorns, there are companies there that have never made a profit. So don't think that these companies are all automatically in profit. That's not necessarily the important aspect. But what is important is that you can research venture capital trusts relatively easily compared to enterprise investment schemes, where most of the research systems tend to be aimed at professional advisors.
And of course, VCTs are companies that are listed on the London Stock Exchange. So as you quite rightly say, the access to publicly available information is kind of much easier than it is on an EIS, which is essentially a private fund. Indeed. And just following on from that, sort of, Stephen, I mean, one of our readers sort of said, you know, do you need to be a sort of high net worth investor to invest money in EIS, CDEIS, for example, or, you know, can you start with, you know, more modest sums of £10,000 or £20,000? So I think there's two questions there. I mean, the definition of what is a high net worth individual is quite a specific one within financial regulation, isn't it?
It is, but I don't think when people talk generally, they come from that particular stance. We do, but because of the regulations. Do I think they're exclusively for high net worth clients? No, not at all. I think it should be driven by what you want to achieve and what you're willing to risk. And as long as you're going in with your eyes open, then I think it's perfectly acceptable to take any of these particular options. And sometimes, of course, although we always play down, and I think it's quite right to do so, the tax advantages, sometimes you should be doing it specifically for the tax reasons. Now, that's always going to be a smaller factor across the board, but sometimes for your specific circumstance, tax is the be all and end all of the solution that you're looking at. And in which case, then it's a matter of doing the appropriate research.
I know in the past, you've always sort of said the tax shouldn't wag the investment, as it were.
Always believe that.
Yes, which is very good advice. And obviously, we've touched on a little bit on the sort of capital gains tax benefits of EIS, etc. Are there any inheritance tax benefits from EIS, CDIS, or VCTs?
VCTs, no. So that's the easy one. And there isn't anything that you can do about that. So that is, of course, the drawback. You can have a wonderful tax-free income and then pay the price when you ultimately pass away. So it's a balancing act, which again, of course, is why we recommend that you do a combination of things, not one thing to the exclusion of everything else. Seed and EIS, in terms of inheritance tax, have exactly the same treatment. Hold them 2 years. After that period of time, they're exempt. Very, very simple, very, very straightforward. And of course, it's probably worth talking, it's outside this particular discussion. But if you've got those type of investments, it is possible to then fold those investments once they become exempt into trusts. And there can be other advantages associated with trust planning, but that's outside, as I've just said, this particular conversation.
And what about the sort of minimum or maximum age for investing in these kind of high growth, well, potentially high growth companies using some of the sort of wrappers? And we've had sort of one reader sort of saying, am I too old if I'm 70, 80, 90, given these companies are early stage? Is there can you be too old to invest in these kind of businesses, even with the tax reliefs taken into account? Okay,
I don't think you can be, because I think that that's a very good example of where the tax planning is actually becoming the dominant factor over and above the investment planning. So if you've done all of your other inheritance tax planning, or you've simply run out of time, given your life expectancy, I can't think of a better way than to ensure that your investment that you put into, say, for an example, an EIS or a seed, is going to be exempt after 2 years. I mean, that's just a fabulous opportunity. But also don't forget business relief, although we've talking about EIS and seed. The business relief products, which are less risky in this context, are also exempt after 2 years. And at another time, we spoke about the fact you can get insurance on those particular products to perhaps get exemption after a week as well.
And I guess if I was a kind of younger working adult, I might be sort of slightly seduced by the potential high growth returns. But again, your advice would be, I guess, to think about what is the objective of investing in this area.
Yes, and then again, as a planner, I'm always going to say, if you haven't done a financial forecast, put it into context, and I'm going to totally relate this to how we operate. We will not give any form of tax advantage planning without putting it within the framework and structure of a cash flow forecast over the next 10, 20 years. We just won't do it.
Just a sort of quick question around the sort of budget. All budgets, seem to constantly sort of talk about the government doing something with capital gains tax. We kind of never quite know until the Chancellor has announced anything if that will be the case. But presumably, in the context of particularly EIS, EIS, the capital gains tax advantages can help with longer term if there are any sort of future changes in the budget around that particular area.
That's a very, very good point. Certainly, we're not envisaging, of course we don't know because we're not the Chancellor, any significant changes to the reliefs around the enterprise investment schemes. And of course, one of the attractions that we've spoken about elsewhere is the ability to defer the capital gains tax liability. Now, that could be double-edged, because you might be deferring something at one rate of tax. Now he increases the rates of tax. So when you come to crystallize that gain, you've actually put yourself into a higher rate tax position in terms of the later charge. But conversely, you can also, if you're in that position, you can bleed out your gain. And of course, as we all know, there are allowances for capital gains each year anyway. So I think the key point is it gives you that ability to choose. And timing is a great advantage here.
And just finally for today, we've got a number of readers who've got sort of buy-to-let portfolios, from one property up to a sort of a group. Presumably in the context of what we've been talking about here, if they were to sell the sell the buy-to-let portfolios and experience the capital gains, then using potentially EIS, CDEIS as a way of mitigating, deferring some of that capital gains might be a route to look at.
That has been a phenomenal area of growth for advice, because a lot of property owners have had enough, because obviously there's been a lot of changes to do with the tax release around property investments. And so people in that space are finding that the returns they once had have reduced. Doesn't mean they're a bad investment, but they're not quite as exciting as they once were. And obviously, as you get older as well, a lot of people don't want the hassle of running an investment portfolio. And the big advantage of seed and enterprise schemes, etc., relative to that type of portfolio is that they're simpler, and they come with an opportunity with a great deal of capital growth, far more than property these days. But I do stress potentially. So you're quite right. The ability to not have to pay that capital gains tax within 90 days is a huge plus. The fact that you can defer it for any length of time in the future, there's no time stamp against that, is also very, very advantageous. And the fact that there's no capital gains on death might mean that if you've converted it into an enterprise investment scheme, deferred the CGT, and you would then die, you've completely eradicated that. And if you've held it for more than 2 years, you've got rid of the inheritance tax. It's a fantastic tax planning route for many people who hold property.
Well, Stephen, thank you very much for your time today. We've covered off some actually, I think, quite complex financial planning issues. And I think the general kind of view would be these are not areas that you can just sort of go into yourself. It is worth taking independent financial advice if you've got sort of fairly complex sort of issues. But for now, Stephen, thank you very much for your time. And perhaps we'll have a chat after the budget and see what the Chancellor has in store for us all.
Sounds good. Thank you.